Let's talk about a major shakeup that's happening right now in Kenya's banking sector. A tradition that's been around for decades is coming to an end, and it's a change that's going to affect thousands of bank employees, all in the name of creating a fairer system for every single borrower in the country.
It really all boils down to this one question. For years, bank employees in Kenya got a very special perk. But was this perk creating a totally uneven playing field? Was it basically an insider's advantage that the average person could never even dream of getting?
And believe me, it was a huge advantage. We're talking about bank staff getting loans with interest rates as low as 3 to 5%. Just to give you some perspective, that is dramatically lower than what everyone else was paying on the open market. It's not even close. Well, the Central Bank of Kenya has finally stepped in, and that whole era of special insider rates, it's now officially coming to an end.
You see, these preferential staff loans weren't just some small bonus. No, they were a core part of the deal, a huge piece of the compensation package in the banking world. This heavily subsidized credit was a massive incentive, making it so much easier to buy a home or a car, and frankly, it made a bank job look incredibly attractive.
But the regulator, the Central Bank of Kenya, or the CBK, they saw things a little differently. They looked at this whole practice and called it what it was, a loophole that created an unfair advantage in the market. And now they've moved decisively to shut it down for good. So what's the fix? Well, the CBK's solution isn't just about getting rid of the old perk. It's much bigger than that. They're introducing a completely new framework for how all loans are priced, for staff and for regular customers alike.
And the goal here is pretty simple, but it's really powerful, to create one system that is uniform, totally transparent, and fair for absolutely everyone. The CBK wants to get rid of all those confusing hidden charges, and maybe most importantly, put an end to any kind of preferential treatment.
So how's this new formula going to work? Well, it breaks down into 3 pretty clear steps. First, every loan will start with a base rate, which is tied directly to the central bank's own official rate. Second, a risk premium gets added on top, and that's based on your specific risk as a borrower. And third, and this one is huge for consumers, is full disclosure. The total cost of the loan, the annual percentage rate, has to be shown to you clear as day right up front. This quote right here, it really gets to the very heart of the CBK's thinking. They actually rejected ideas to make an exception for bank staff, arguing that uniformity is absolutely essential for fairness. In their eyes, you just can't have one set of rules for insiders and another set for everyone else. You have to understand, this is a massive shift. For decades, these special loans were just how things were done, a standard part of the job. But come September 2025, that all changes. A whole new era of transparent loan pricing officially becomes the law of the land. Okay, so of course a change this big is going to have a direct and pretty significant financial impact on the thousands of bank employees who may have built their financial lives around this benefit.
I mean, the contrast couldn't be near stark. The old system was all about subsidized, preferential rates that were treated as a key employee perk. The new system? It's all about standardized, market-based rates with the exact same pricing for every single person who walks through the door. And the consequences are real. First off, employees are going to face higher borrowing costs, which right away means less disposable income. It's also expected that a lot fewer staff will even take these loans now. And that might actually force banks to go back and completely rethink their compensation packages if they want to keep their top talent. But look, while it's definitely a tough adjustment for the staff, the CBK is arguing that this whole reform is about the greater good. It's designed to benefit the entire country in the long run. So what are these wider benefits? Well, it's really built on 3 key pillars. First, transparency. This means you can finally compare loan products apples to apples. Second, it's going to spark healthier competition, where banks have to compete on service, not tricky pricing. And third, it gives you real consumer protection by slashing the risk of getting hit with hidden fees. So, at the end of the day, what this means for every Kenyan looking for a loan is that the era of confusing, opaque pricing and nasty surprise charges, well, it's over. The whole process is about to become much, much clearer.
All right, so let's zoom out a little. What does this all mean for the bigger picture? This isn't just a random rule change. It's really a statement about the future direction of the country's entire financial system.
When you boil it all down, this is a move to build and strengthen public trust. The whole idea is that when everybody plays by the same set of rules, it reinforces faith that the banking sector is actually there to serve the public fairly and transparently. And, this isn't happening in a vacuum. This reform actually brings Kenya up to speed with global best practices. Many other major economies have already moved to standardized loan pricing. So this is a really key step in modernizing the country's financial system. And so this leaves us with one final big question. The goal of fairness? It's crystal clear. And the benefits for the public seem pretty undeniable. But for the thousands of employees and the banks who now have to adapt to this new reality, the transition is going to be a real challenge. The principle is sound, for sure, but will the practice be easy? That's the question.